Houston, we have a problem. Markets sold off today quite aggressively. Even Tesla was positive at one point today and completely sold off into the close of trading. Now, what's coming for Tesla next? Some people have been talking about $200 per share, less than that, or potentially a massive rally from here. What do you need to know as a Tesla investor? And where is Tesla stock going over the next couple of months? Well, we have a couple of different scenarios that could ultimately play out that you need to hear. So let's go ahead and get into it. If this is your first time to the channel, hit the subscribe button if you want to stay up to date with all of this information every single day in the hopes that it helps you make more money. So I know you guys have heard people talking about a crash coming for Tesla. And specifically for Tesla, people either love the stock and love the company, or they absolutely hate it. Same goes for analysts. And I will tell you right from the start of this video, for the next couple of months, what happens to Tesla stock is largely correlated with what happens to the broader markets. Unless we get some random out the blue news that is good or bad, Tesla will follow the broader markets. But it tends to have a much higher beta than the broader markets. So if the markets fall, Tesla tends to fall more. If the markets rally, well, Tesla tends to rally more than the broader markets. That leads us into the first problem that Tesla is going to have that could pull Tesla stock down. And that is mega cap earnings. They were not good. Apple earnings were not good. Microsoft earnings were not good. Google earnings were better than expectations, but still not great. Most of your mega cap tech companies that control the vast market weighting were not good. Apple specifically is a problem child. Apple just seen its third declining revenue quarter year over year. If you could categorize stocks as recession or not, if stocks could go into recessions, Apple would be in a recession. That's why the stock is seeing its worst day in the last 12 months, dropping over 4% on the day today. Apple is 12% of the weighting in the markets. Now, what you have seen throughout this earnings season so far and last earnings season was if a company had good earnings, you tended to see a pretty good follow-through effect, meaning that if the stock rallied 5 or 10% after earnings, it tended to continue to do well after earnings. Vice versa. If a stock had bad earnings, it tends to do bad the next weeks or months after earnings. You can even see this very much with Tesla. Tesla reported earnings back here. It was at $300 per share. Tesla's earnings were actually great. Elon Musk said there's a chance that Tesla does cut prices. The stock fell after earnings, almost 10%, and then continued to fall from there. From the opening level the day after earnings to where we sit now, Tesla stock is still down about 9%. So the follow-through with Tesla was negative, as you can really expect from any company that has bad earnings in this market environment. Tesla hit its low down almost 11% following the open the day after earnings. So what does this mean for big tech that just reported earnings that was negative? Well, the same thing applies. People are going to sell those stocks. Your Apple likely to continue lower. Your other big tech names likely to continue lower. Even something like an Amazon that is doing well today could be overshadowed by the broader big tech earnings that were much worse than them. Meaning that Amazon is likely not going to be the company that saves the markets when Apple is crashing. I think that's a pretty universal statement. I think that's something you could agree with Very much so. The good news is the economic data that we got today was very encouraging. The unemployment rate actually fell to 3.5%. Non-farm payrolls came in at 187,000. Very positive. And it's hard to say we're heading into a recession when the unemployment rate is 3.5% and just fell. But the simplest way to say it is markets are overvalued. Your big tech names that are not growing are not justifiably valued. The valuations are extended. Very much so. Stocks like Apple, Microsoft, etc. Something like a Tesla could be cheap. I say could be. If things go as planned. If margins can hold up, maybe up or down 0.5% or so, not a huge problem. If Tesla is forced to continuously cut margins, and somehow demand just isn't as strong as we expect in the next 2 quarters, there is a case that Tesla could fall from here. But without that happening, it's very hard to make a bearish case on Tesla. You've seen a lot of good news recently, and there's more good news to come. As Gary Black said yesterday, there's 9 upcoming catalysts for Tesla. Stable auto gross margins, the M3, the Model 3 refresh, the Highland, that's coming in Q3. The Cybertruck launch in Q4. Licensing of full self-driving, which could come in Q4. And the Fed's pivot on interest rates, which could come in Q4 as well. These are all positive catalysts for Tesla. So I'm not worried about the business itself. I think things will accelerate the rest of this year and things will be fine. But the market's perception, well, it can vary. And if the markets start to say, hey, Tesla's going to see decelerating growth the rest of this year, well, that could be your buying opportunity to buy the stock. Again, I don't think that's going to happen. But if the markets get into this state of panic, people start to really over-exaggerate everything. Same thing on the euphoric side. Everyone has been overly euphoric on big tech stocks. Now you get earnings that kind of crushed their hopes and dreams. Apple is not growing. Should it be at a 30 PE for 2024? Probably not. That's a problem. If you also look at something like the Atlanta Fed GDP Now tracker, the Atlanta Fed is expecting 3.9% GDP for Q3. The top 10 analysts on the high side and the top 10 low-end analysts are expecting GDP on the high end to be about 1.7%. On the low end, expecting GDP to come in at negative 0.5%. So, bottom line, someone is wrong big. Odds are most people are wrong very big. Very, very big. And there's a huge divergence here. Now, during times of divergences like this, the last time we had this was October of 2022, when the market sold off aggressively. Coincidentally enough, in October of 2022, is the last time you've seen 10-year treasury yields this high. And what happened? The markets fell. That's because when everyone is everywhere and there's no consensus view on anything, then there's not a lot of, unanimous opinions. And that makes stocks very vulnerable. Considering what we've seen with Apple, this kind of changes the game. I've talked about this before, and I'll say it again here in this video. If Apple had bad earnings, it was going to drag down the entire markets. Now, Amazon had pretty good earnings. They had great earnings. But Amazon earnings do not have a larger effect on the markets than Apple. There is no other company that has a larger effect on the markets than Apple. So when Apple is crashing like it is today, seeing its worst day in the last year, it's not going to be good. Now, what we have seen last earnings season and this earnings season If a stock had bad earnings, and Apple had really bad earnings, well, it tends to continue to sell off. If a stock had good earnings, it continues higher after earnings. Well, Apple is again seeing its worst day in the last year. It's likely to have some pretty bad earnings. Now, what could this do for the broader markets as well as Tesla stock? And I've also said this many times. Tesla is not going to fall independently from the markets. But if the markets fall, Tesla's going to fall more than the markets. Vice versa. If the markets rally, well, Tesla's going to rally more than the broader markets. It's as simple as that, by almost a 2-to-1 ratio. So if you're someone that thinks Tesla's going to fall to $200 per share, that would be a fall of about 20% from here. That means that you would be forecasting the S&P itself would fall about 10%. That's a pretty reasonable bet, to be quite honest. I would assign probably a 65 to 70% chance based off of big tech earnings and the disappointment that they were, stocks could fall 10% from here. I think there's a lot of that buy the dip momentum out there. I think a lot of people missed the rally that you have seen in 2023. So I think people will be buying the dip because the economic data has been so good. Like we said, the unemployment rate is at 3.5%. We just added 187,000 jobs. It does not look like we're going into recession. So the worst case scenario should not be expected here. The bottom line is, earnings were not good. They don't justify where big tech stocks are trading at. So there needs to be a correction. They need to come down, and that's okay. But again, that means Tesla would fall more. And I would assign that about a 65 to 70% chance. Now, there's a 30 to 35% chance, in my opinion, markets look past Apple earnings. And markets say, hey, things are going to get better from here. The Fed is expected to cut rates in March of 2024. 30-35% chance markets say, hey, we're just going to look forward to when the Fed cuts rates, and it's okay. It's fine. After all, if you look at the S&P's PE ratio, sure, it's elevated from what we have seen in the S&P's history. You're trading at the higher end levels. But it's not too high, okay? It could be higher. So yeah, valuation's a concern in your big tech names, but not in the lower end segments of the markets. When you look under the surface, the valuation's pretty appropriate. If you look at Apple, Microsoft, some of these bigger tech names, those two stocks control 25% of almost 25% of the S&P alone. Well, the NASDAQ alone. Well, they're overvalued. So money rushing out of those stocks like we're seeing today is going to have a negative effect on the broader markets. It's going to have a negative effect on everything. But I think that only happens to a certain extent. Like I said, 10%. That's what I would expect to happen, the highest likelihood from here, about a 10% drop within the next couple of months or so, the next month or two. That's reasonable. That's justifiable. If you're someone that's expecting Tesla to fall under 200, just don't hold your breath for that, okay? You're going to turn blue in the face, and it's not going to happen. Unless something crazy happens, and there's a black swan event in which I can't forecast that. But it does look like we are in for some downside here. And that's okay. That's fine. Let me tell you right now, when the Cybertruck starts deliveries, when we get the next delivery number for Q3, which I believe will be another record, when you get the first licensing a full self-driving deal with an OEM, these are all catalysts you want to be invested in Tesla for. And they are catalysts that will happen within the next 3 to 12 months. Not to mention V12, Alpha V12, or 12V, fully autonomous vehicles that can support robotaxis coming, as Gary Black believes, sometime in 2024. These are all massive catalysts. These are all catalysts that will take Tesla stock to new all-time highs. The fact of the matter is, analysts are wrong when it comes to Tesla. That's to your benefit right now, to know analysts are wrong. Analysts expect Tesla's delivery growth to be 27% in 2024. That would be the lowest that it has been at in recent times. The last time Tesla released a new model was the Model Y on March 13th, 2020, and deliveries grew over 80%. 80% the next year. And analysts are forecasting 27% growth. Gary Black expects over 50% growth. I expect in between 50 and 60% growth. That's over double what analysts are expecting. So they're wrong. That means they're wrong on Tesla. And that means the stock likely rallies exponentially from here. Now, new all-time highs. I think that comes down to licensing of full self-driving and fully autonomous vehicles ready for some submission to application for robotaxis to the government. That's what gets you those all-time highs. On top of, this crazy low expectations from analysts for 2024 numbers. When you get those things, 6 to 12 months from now, if you could fast forward, you're going to say, dang, dude, I should have bought every share I could when Tesla was $255 or $200. That's a gift for long-term investors. The most important thing in investing, investments, anything that has to do with money, remember this. You make money on the buy. Doesn't matter. You always make money on the buy, not the sell. So the cheaper you can get Tesla, the more money you're going to make and the higher likelihood that you're going to make money. Obviously, right? It's pretty simple to see that Tesla is going to become the largest company in the world, so on and so forth. But you really make money on the buy. So this is an opportunity if Tesla does fall to as low as $200 per share. Now, I think the markets right now are in so much of a buy the dip kind of mindset. And I think a lot of people, like I said, missed out on what's happened in 2023. They want to take any chance they can, any slightest drop, and buy it. And I think that's going to be the case. And I think it's justifiably so in stocks like Tesla that are trading too cheap or other small mid-cap stocks. I think that's justifiable given the economy is not heading into a recession right now. And the one negative catalyst that I was expecting could be bad for the economy was student loan repayments towards the end of this year. Well, Biden is making it so only 5% of your discretionary income needs to be paid back with monthly student loan payment. It used to be 10%. And if you make less than $15 an hour, you're not going to have to pay anything to your student loan payment. This just dramatically reduced the negative effect this will have on the economy. So sure, it's going to have some kind of effect, but I'm not convinced it's going to be the thing that gives you a recession. So I don't see a recession. Without a recession, this is only going to be a minor correction and should be viewed as a buy the dip opportunity because in the end, analysts are wrong about 2024. So the rest of 2023, the next month or two, yeah, Apple had bad earnings. It could be a little bit of a shit show. That's true. Apple's trading way higher than it should be today. And Apple is in a recession. But that will only last so long. And Tesla, again, it's only going to fall as much as the broad markets fall. Well, more than the broad markets, but it's not going to fall independently unless we get some crazy bad news. Vice versa, when the markets do start to recover, Tesla is going to massively outperform. So, again, 65-70% chance Tesla could fall as low as $200 per share. There's going to be a strong level of support around 240. So obviously, if you break under 240, then you start to talk about 200 as a little bit more likely. But a 65-70% chance you could fall as low as $200 per share. As low as. I wouldn't expect anything lower than that. But there's a 30-35% chance you could actually start to bounce. Maybe it's 240, maybe it's 250, maybe it's where we are now at about $255. And you start to bounce and make your way higher as investors brush off earnings and they start to look forward to the next rate cut. If you guys would like to come trade with us live in real time, if you don't want to sit there and watch your portfolio decay and you actually want to be able to profit off of this, well, link down below in the description of this video. Come join us. We are trading every single day over there. Currently, we have a trade on Apple. Spent about $400 on it, but it could yield $46,000 if Apple does fall about 10 to 15%, which would put Tesla at about $200 per share. If that were to happen, then that would be one of those moments where you sell out of that Apple trade and you go buy the dip in words that I cannot use on YouTube. Right? You go crazy. Okay, that's ultimately the idea of that hedge. Now, let's summarize this. You're likely to get a fall in the markets. You're likely to see Tesla fall. Ultimately, it's a buying opportunity. Why? Because we're not heading into a recession. There's very few things that you can point to that are catalysts that are sending us into a recession as we speak. Obviously, there's things that could happen down the line, but it does not look like that's the most likely outcome. If that changes, I will keep you guys informed, but we're not there. Even the student loan repayments, that's the one biggest negative thing that I had projected for our economy in 2023 and 2024. Those payments starting up again was going to take a lot of discretionary income away. Well, the government cut payments in half. Instead of 10% of discretionary income towards a student loan payment, it's 5%. And if you make less than $15 an hour, you're not going to have to pay a payment at all. That dramatically reduces the odds of a recession. So that's the nutshell here. There's a 65 to 70% chance Tesla could fall as low as $200 per share. Doesn't mean it has to fall to 200. There's probably a 15-20% chance it falls to 200. The rest is in between 200 and 220 and where we are now. Odds are you probably fall to about 230 if the markets were to fall. 7% give or take in the S&P, 14-15% give or take with Tesla. That's more likely based on Apple earnings. So let me know what you guys think about this down below in the comment section. Are you just waiting for this to happen? Waiting to get into Tesla positions at a cheaper price? Is this good news to you? Let me know down below in the comment section of this video. Thank you for watching. Hit the like button and subscribe to the channel if you made it to the end of this video. I apologize. This video is kind of raw compared to the videos we usually put out, but there was just a lot of information I wanted to get to you as soon as possible. So there you have it. Enjoy the rest of your day and your weekends, and I will see you in the next one.